Welcome everyone, I'm Matt Franklin, your portfolio coach, and this is Portfolios 100, The Basics. In this lesson, we're going to introduce you to our grading methodology, the basics of asset analysis and portfolio construction. As well, we'll cover portfolio optimization and applying risk aversion, which are methods that help you understand how to balance your portfolio. Throughout this training, we've segmented everything into these different lessons and chapters. We did that in the hope that it would make it easier for you to go back if you want to reference something later on. You can also get a copy of this presentation if you navigate to the materials page on our website, select this lesson, and then in each lesson's page, you'll find the PDF document. Also, whenever we move into a new chapter, you'll hear this sound, so you know we're moving on to a new topic. At the core of this training program is our grading methodology, so let's cover that first. Essentially, what we're trying to do here is take complex statistical measurements and apply the results comparatively across the grading scale. The grading scale uses B- as the average, which does give a few more grades on the higher end, and initially we used a C, but it didn't make very many investments look as appealing, so we moved it around and found that B- provided a good balance. This method came about because I had a hard time understanding how to apply the statistics that they teach you in these finance courses to making real-world decisions. And, that might sound silly, but it's not that I didn't understand the statistics. It's more like I would analyze two stocks and get two different Sharpe measures. And we'll explain that more in a little bit. But say one stock was a 0.34 and the other was a 0.51. Now, obviously, one number is higher than the other, but I wanted to know what that meant and how those numbers compared to other investments that are out there. Was I making the best investment that I could? And how did it really compare to those other options? So that's where a lot of this stems from. It was just a drive to translate all these statistics into something that was relatable to me. And after doing a lot of testing, I arrived at two different grading concepts. One for stock grades, for comparing the performance of the different statistics across the population of investments. And the second is for portfolio grades, to help you identify where the risk is coming from in your portfolio. So let's take a closer look. With stock grades, just to give you an example here, the grades are distributed across the grading scale like we just discussed, and that's done for each of the 5 different metrics that we offer. The higher their result is, the higher up they are on the grading scale. And while this may seem simple, in our tools you can change the grades to be based on up to 5 different metrics and even incorporate different historical time periods so that you can better leverage different strategies. And in Portfolios 400, we'll go through the performance of the different strategies and how, in our opinion, is the best way to leverage each. All you need to know for now is that the grades will change based on the metric you're using for stock selection. The second letter grade is the portfolio grade. This grade is designed to help you identify the asset's contribution to the overall risk in your portfolio. And as you can see in this example, the first letter grade is the letter grade that was assigned based on the statistical measure, and the second letter grade is the grade that's added to identify the asset's contribution to the portfolio's risk. So a lower letter grade here indicates that the asset is contributing more risk to the portfolio. The asset adding the most risk to the portfolio we designate with the letter R. You can see one stock here with a B+ and another with a C. And then when you combine them, however, what you might find is that they don't interact all that well together. And what that means is individually they might be great choices, but when combining them with the rest of your portfolio, maybe they don't interact in the right way and they're forcing you to take on more risk. So in working with the second letter grade, A isn't always necessarily what you're striving for. You want to use it just as a point of reference. It just shows you where the risk is, and you don't want to eliminate risk from your portfolio. You do want some because that's where your return is going to come from. But what the grades can help you do is compare fits and different combinations in an effort to identify the right stocks for your portfolio. For example, you may want to include like a hotel stock in your portfolio, but as you go to add the company, the one you thought you wanted to invest in, you find out that it doesn't interact well with some of your other investments. So maybe you try out a few other companies in that industry and you may end up finding another one that actually works out really well with the assets that you already have. So think of leveraging these grades as a way to help you narrow down your choices and find the right investments for you. A lot of times I'll use portfolio grades and start with maybe like 20 stocks initially and review the grades and then narrow it down to what I consider to be like the best 12 or maybe whatever quantity goal I have in mind. And to me, that's part of the fun. And if you can understand these two grades, then the rest of this should be pretty fun and easy. So once you have your stocks compiled, what's next? How do you know how much to invest in each of them? And that's where this concept of portfolio optimization comes in. Finding the optimal portfolio is an important part of how professionals decide how to arrange their portfolios. And you need to understand that optimization does mean something mathematically. And we'll explore the specifics of that later in Portfolios 200. But essentially what that means is that you take the assets that you want in your portfolio, and then the computer will test a whole bunch of different combinations and see which ones produce the highest return while taking on the lowest amount of risk. Optimizers will then show you that set of weights from that optimal portfolio, and then those are the weights that you want to use when making your investments, since out of all the potential combinations that were tested, those are the ones that perform the best. And in the example here, we do have another letter grade associated with the optimal portfolio. This letter grade is associated with where the portfolio's Sharpe measure falls within the overall population of the stock Sharpe measures. And that's just there to give you an idea of what kind of investment you built. The combination of all of your investments is the vehicle that you're building, and we just want to give you a comparison to what's available in the market. Now that we've introduced you to a few of the core elements of this training program, we wanted to take a break for a moment before getting into the next topic. Throughout our lessons, we'll stop from time to time in an effort to engage you and reinforce these topics, but in another way. So let's get started with the first question. Letter grades are offered for what two functions? Is it A, asset grades and portfolio grades, B, portfolio grades and return grades, or C, return grades and index grades? The answer is A, asset grades and portfolio grades. All right, asset analysis. So where do you start? Well, we're going to start with the metrics that are available in our system, and we'll walk you through them, why we picked them, and how they work. We're also going to walk you through the historical time periods, why that matters, and which historical time period actually works best for the different strategies. And then we'll get into beta, what that is and why that's important. Beta can be a great measuring stick when trying to understand what to expect between your portfolio's performance and the markets. Now, where are all these methods coming from? A lot of these are academic methods that are studied and taught in universities. These methods are common, but we wanted to find out what really worked. And in order to do that, we created a computer system that can analyze all of the stocks on the New York Stock Exchange and the NASDAQ. And from there, we created an automated portfolio construction method that helps us bring our testing process together. We began by testing a variety of questions over a time period from 2008 until 2020. And initially, we optimized our portfolios 4 times a year and built a separate portfolio for each of the different metrics. Then we tested the grades to see which ones performed best at identifying assets to include in the portfolios. Then those test results ultimately became the foundation for much of what we're walking you through throughout these lessons. And many of the academic claims about portfolio management, we feel were validated by our testing, which of course makes sense, but we'll get more into what those are. And there are some pretty interesting results that we're looking forward to sharing with you. And we'll cover all of the testing results with you in Portfolios 400. Getting into the different grading metrics, there were 11 different metrics that were originally tested. We're not going to get into what every single one of those were, but we arrived at 5 that we feel best represented different investment strategies. Since some of those metrics are fairly common and others a little less so, we're going to walk you through what each of them are, what they mean, and how to apply them. But as you can see here, these are the test results for the different metrics, starting at the top with the expected return, then Sharpe's measure, Trainer's measure, alpha, and our overall average. And from left to right, you'll see how they performed over the different historical time periods. We tested 6 different time periods: 90 days, 1 year, 5 years, 8 years, 10 years, and 15 years. We wanted to see exactly how these metrics performed when we used them to select our assets and invest over a period of time. And as you can see, there are certain metrics that across the board tend to perform well, and there are others where you only want to pair them with certain historical time periods. My favorite metric for stock selection is Sharpe's measure, or Sharpe's ratio. And you can see here when you leverage that metric, you really want to use a 5 to 10 year history. And you'll notice that alpha is another one where you only want to use certain return time periods. And this time you'll want short term, like 1 year or 90 days. And then getting into the grade average, this is just an average of the stock's ranking in each of the other 4 metrics. We actually tested a variety of different mixes for this 5th metric, and the average of the other metric ranks actually performed the best overall. And we'll get more into all of them in Portfolios 200. This next chart shows the average return for each metric across all of the time periods. So looking here on the left, you've got the S&P 500, then the annual returns for expected return, Sharpe's measure, Trainer's measure, alpha, and then the overall average. Now, many of you might look at this chart and think, why would you ever choose anything other than expected return or Trainer's measure? And the reason why you wouldn't do that has a lot to do with beta, and we'll get more into that in a moment. The short version of the story is that you need to consider that the portfolio's asset selector is a computer, and it's going to make choices that most of us would not. And in our first attempt at this, it resulted in some questionable selections that did get lucky, but showed pretty dramatic variability. So as we adjusted our methods to take beta into consideration, we found that the results were a lot more believable, and the tools were also selecting assets that most of us would consider. So being able to stomach a portfolio with a high beta is not a badge of honor, so please don't go down that path. Like I said, Sharpe's measure is my favorite metric to use. It's just a very stable, consistent, and reliable metric for identifying good long-term investments. That said, each metric can offer advantages depending on the market and your timing. We'll get more into market timing and what we mean by that in Portfolios 500. Taking a closer look at historical time periods, you might say, well, why are you looking at 6 different time periods? And part of that goes back to me just asking a lot of questions and looking at a lot of the data that's out there, specifically stuff that's published by some of the others on the mainstream websites. And when I was trying to validate the math in the system, we found that a lot of the sites that are out there actually use 5-year histories for their metrics, which if you look at the returns, that may or may not be a good way to look at some of the metrics to use for stock selection. So what we found as we were working through this was that depending on the metric, the historical time period mattered and should really be considered when developing your strategy. So overall, in terms of just averages, we did find that for all of the metrics we included, that on average, the best performing historical time period is 10 years. When you use our technology, that's our default. Now, 10 years of history should work well for most of the measures, but depending on your strategy, you may want to consider making different selections. Okay, beta. A few moments ago, I mentioned that you may be interested in why expected return or trainer's measure might lead you down a path with a strategy that's a little bit more difficult to stomach. Essentially, what you need to understand is that for a lot of the assets that have high expected returns and trainer's measures, they're going to move a lot with the market, and beta is the measurement that will help you understand by how much. So if we look at this chart on the left here, this black line would represent an index like the S&P 500. So this is how that particular index would be moving over the course of that week. What you can see here is if you have a beta of 1, you have the orange line. Well, you can't even see the orange line because it's hidden behind the black line, which is the concept of a beta of 1, meaning that the stock is essentially just moving proportional to the index. Now, it's true that it won't look like this chart. Not every move every day will be aligned, but over time, the movements are going to be proportional to the index. So if you're looking at a stock with a beta of 2, for every gain or loss in the market, the gain or loss for that stock is essentially multiplied by a factor of 2. So what you're seeing with some of these assets that the computer selected, for example, were assets with betas of 4 or 5, and in some cases even higher. So you can just imagine if the market loses 2% in a day and you've got a beta of 5, well, you just lost 10%. Now, you could have gained 10% as well, but that's what I'm getting into about the volatility that beta can help you identify. So you really need to know how that works, because if you select a whole bunch of assets that have betas of 2, 3, 4, or 5, or even higher, then what you're going to have is a very highly volatile portfolio where you could gain or lose 10, 20, or even 30% in a day. And I don't know about you, but most people can't handle that kind of stress. So what you're looking for in your goal with beta should be to find assets that are close to or near 1, and that will provide you with a portfolio that moves a lot more like an index fund. All right, it's time for our second question. Most popular financial websites use what time period for their returns? A, 12 years, B, 3 years, C, 5 years, or D, 10 years? Now, I did say this, I don't know if you caught it. The answer is C, 5 years, which, as we just talked about, might not be helpful based on your strategy. Now, getting into portfolio construction. So what are we talking about when we say portfolio construction? Well, we wanted to look into things like portfolio size, meaning how many assets you should include in your portfolio. We wanted to get into researching indexes for optimization, indexes like the S&P 500 or the Dow Jones Industrial Average, essentially to understand if changing any of that made a difference. And then we got into things like the optimization rate and tried to figure out how frequently you should rebalance your portfolio. And in our initial testing, we talked about how we optimize the portfolios quarterly or 4 times a year. So for this next step, we created a new method that was set up to test how often you should actually rebalance your portfolio. Now, there are some academic methods that talk about this, and that was kind of the original inspiration for some of these questions. So we'll show you what we did, and in my opinion, the results make sense. The first thing we got into was portfolio size, or the number of assets that you should include in your portfolio. We tested quantities of 5, 8, 12, 20, and 30. And we did that so we could see a variety of different sizes to see if that made a difference. When choosing the number of stocks for your portfolio, you should also consider the amount of time that you want to spend on your research. So if you think about it, a portfolio with 30 stocks really has a large workload that comes with it, and you might only have time for a portfolio with 5 stocks, and that's okay. When you only have a few, you might think that that's actually more risky, but as you can see here, depending on your strategy, and we'll get into this, that might actually be preferred. So what we found was that on average, the best performing portfolios tended to be in the middle. And for certain metrics, it did say some quantities perform better than others. But on average, it showed that the portfolios with 12 assets perform the best. Now, that said, when you look at each of the individual metrics, you find that certain quantities of assets tend to work a little better than others. And earlier I mentioned that I like using Sharpe's measure. For me to get the best possible return, I should go with a portfolio of 8 assets. Now I could also go with 12 assets or even 30 if I feel like it. Those portfolios outperform the market, but why would I want to keep up with more if I can get a better return with just 8 or maybe 12? Which that range, that's also what academia taught me was ideal. It seems like for most metrics, you should include anywhere from about 8 to 12 stocks in your portfolio. But if you want, you can include up to even 15 or 20. Anything beyond that, really, unless you're a fund manager where like it's your job to keep up with them and all you're really likely doing is giving yourself a whole lot of hassle for not much more return. And, the point of all this training is really to learn how to work smarter with all of this and not harder. An old manager of mine used to tell me that effort does not equal results. And he's right. You have to know what kind of effort gets you the results that you want. And in this case, all we're saying is not to overindulge with investing, which most investors will agree is easy to do. Plus, once you're in that neighborhood of 30 stocks, you might as well buy an index fund. And this training is more aimed at helping you understand how to build and manage stock portfolios rather than, purchase index funds. In terms of testing the index, there were 3 measures that we leverage in testing where that could make a difference. It's alpha, trainer's measure, and then the overall average. So those are the metrics that we tested here. We changed the index between the Dow Jones Industrial Average, the S&P 500, the NASDAQ Composite, and the New York Stock Exchange Composite to see what differences that would make. Taking a look at the results, there's really not a noticeable difference between them. The best performing in terms of the highest average were the New York Stock Exchange Composite and the S&P 500. The median was the Dow Jones Industrial Average, and each of them for at least one of the time periods did rank as the number 1 index. So we leave the default in our reporting as the S&P 500. That's the red line on this chart, which gives you a pretty good return and really the optimal return for several time periods. If you want to see stock metrics based on different indexes, you'll probably have a hard time finding anything like that. In the end, there's really not much of an advantage. So, kind of what's the point? Our computer system can do it, but right now it's not included in any of our reporting. Probably the topic you're most interested in and will remember after this lesson is portfolio optimization. So what do we mean by portfolio optimization? Well, the term optimization refers to finding the set of asset weights that produce the optimal return, which is the portfolio combination that was tested with the highest return for the lowest amount of risk. And we'll walk you through all of that in more detail in Portfolios 200, but for now, we're just providing an introduction to this topic. Now, as you can see here, we went back and revisited our portfolio construction method to come up with a new way that took beta into consideration. And in these returns, you don't see quite the dramatic swings that you saw with the other studies, but nevertheless, it does paint a clear picture of which ones outperform the S&P 500. We wanted to test daily optimizations as well, but we didn't have the intraday data for that. That might be something we look into in the future, but in general, we tend to discourage folks from day trading unless you have some really powerful tools that are going to help you, keep up with the market. We'll get more into that in Portfolios 400 when we discuss strategy. We actually call it popularity-based trading, where essentially what people are trying to do is trade off of the peaks and valleys of the events of that day. And in general, we discourage from that because what you're trying to do is time the market, which can be a bit of a fool's errand. And in this training, when we use that term market timing, we mean something different. Now, it's true that when you have a few $1,000s, you can flip it a few times and make 300, 400%. The problem most people run into in that situation is when they do have more money, they try to do the same thing, and the volatility becomes something that catches up with them. So trading without really knowing what you're doing, it can still feel great, and then all of a sudden, if you do it right, you might end up with a pile of money. And then some people become terrified at that point, and then they don't do anything with it. So when you end up with a larger amount of money to invest, you still want to be able to have fun and take risks, but you want to diversify your risk, and this becomes way more important. And that's where portfolio optimization comes in and become a helpful way to reassure you that you're making the right decisions. Now, what a lot of people want to do is look at their stocks all of the time, but what really stands out to us was that even if you're looking at your portfolio every week, meaning maybe you're making trades on a weekly basis, the reality is you're probably not holding on to your assets long enough to create any value for your portfolio. And, if a week isn't long enough, are day traders really generating value? And what we found was that from about 2 weeks out to about 8 weeks, that's where most of the value creation is in your portfolio. And if you hold on to your assets a little bit longer, certainly it's understood if you have some dividend paying stocks where you don't feel like you have a need to check them as frequently, but ultimately you want to revisit your optimal portfolio and rebalance at least twice a year. So if you're checking it weekly because you're thinking you're going to get some hot tip or some lottery win type idea, what you're really doing is you're extending yourself and you're putting in energy way beyond what's required. And you probably, have much better things to focus on. So in reality, you only need to check your optimal portfolio and potentially rebalance about every 2 to 8 weeks. Or an easier way to think about this is maybe once a month. So if you think about rebalancing your portfolio about 12 times a year, that's not so cumbersome. And doing the research to do that doesn't take a whole lot of time. Come on, some of you, myself included, probably spend more time setting your fantasy lineups or looking at sports news or the latest celebrity gossip. So don't be afraid to spend some time doing research for your portfolio. Now, a moment ago, I mentioned market timing, and I said that that's not necessarily how we view it in this program. Market timing is generally used when referring to people that are trying to time the market, meaning to buy when stocks are at their lows and to sell when they're at their highs. And the problem is that's very hard to do, and there's generally, a lot of stress associated with trying to get it right. Plus, when all of it is said and done, you miss out on those moments of unexpected returns when the market does the opposite of what you thought it was going to do. So maybe, you went out and you shorted the market, or you sold your stocks because you thought that you were trying to time the market properly, only to find out that the market took off and missed out on further returns. This sometimes happens more frequently than we would like. And what we're trying to get you to understand about market timing is not about when to jump in, but rather which strategy to use based on the current market conditions. So some of these metrics, depending on what's going on during that year, will perform better than others. So when you see a growth year, there are some metrics that might perform a little better. Like if the economy is really booming, expected return picks are generally going to work out pretty well. But again, if you're looking at a lot of these years here in the 2010s and you're trying to find a particular metric that works consistently over time, I would take you back to my favorite metric, the Sharpe measure. That one, it doesn't always have the best return, but it typically performs well, and it also limits losses in down years. So overall, you can see that each metric has years when they perform very well and at their best, and then some metrics do tend to fit certain market outcomes better than others. Now, we can't predict what the market is going to do, but we can show you what has worked and what is working, and that will give you an idea of how to plan and how to look when selecting stocks for your portfolio. Now, in our training program, we're not going to offer any predictions for how we think the market is going to perform, because that's very difficult to do. And, there are a lot of great professionals out there that you can talk to, as well as even others online, where you can listen to their podcasts or subscribe to their channels. People who monitor those sorts of things more closely and can give you a better understanding of how they feel the market is going to perform and what to expect. And those individuals are doing a lot of analysis and research in order to make a lot of those predictions. We're just here to coach you on how to manage your portfolio while showing you what's working. That way you're better prepared when determining your strategy and making your picks. So in terms of the results of our studies, we have a technical research overview on our site where we go through all of the research and testing that we did in more depth. Our intention with that is to update it at least once a year so that way you can see what's working. Now that said, when you combine everything that we've tested, what do the results say? Well, depending on the type of year that you think we'll have, whether you're predicting a flat market, a growth year, or you think it could be more volatile, there are different metrics that tend to work better in those situations that you can take advantage of. And even more so than that, you have to consider the return time periods that you're using and even how many assets you're including in your portfolio. All of those things should be considerations based on the strategy that you pick. Now, ultimately, what we're trying to do here is not necessarily define a strategy for you, but educate you so that you can understand that there are different strategies out there and how our testing shows to use them for the best outcome. Now, from there, you can go out and you can pick the assets that you want and then build and manage the investment portfolio that you've always wanted. So just to try and summarize what we're coaching here, at this point, hopefully you've started to get the gist of it, but so it's a little bit more clear, I wanted to lay out the idea a little better. You start with trying to figure out what metric or strategy you think will work best for the current market conditions. Then you use the grades to search through and compare assets. Once you have the assets that you want, you optimize your portfolio and apply risk aversion so your risk is balanced. And then from there, it's all about checking the optimizer about every 2 weeks and deciding if you want to change anything. Now, whenever you do go to make changes, whether that's buying more or selling off some of what you have, or maybe you just want to rebalance to a new optimal portfolio using the same stocks. Whatever that motivation, you always want to weigh your decisions with any potential tax implications. And that's one of the main reasons why it's always a good idea to consult with a financial professional before making any changes to your portfolio. Now, keep in mind that while this program is here to help educate you on how to manage your portfolio, we'd always encourage you to work with financial professionals and have a touch point with them before making any changes. That will help you avoid any unforeseen pitfalls and give you a different perspective to consider before making any changes. Let's take another break for a moment for our third question. When you hear the term optimal portfolio, what does it mean? Is it A, the portfolio with the highest return, B, the portfolio with the lowest risk, C, the portfolio with the best average rank, or D, the portfolio with the highest return for each unit of risk? The answer is D, the portfolio with the highest return for each unit of risk. Really, optimal refers to the portfolio with the highest slope on the capital allocation line. But what does that even mean? We'll walk you through that along with an example in Portfolios 200. Now that you've seen how simple this can be, hopefully you're getting excited about building a portfolio. And while understanding the basics of stock selection and portfolio management is important, understanding our final topic in this lesson is really the key to bringing all of this together. So I want you to pretend for a moment that this course is over and that for practice, you've already built a few different portfolios. And maybe on your fourth try, you've landed on 10 stocks where you really like the balance from the optimizer. But being a cautious person, you decide to set up an appointment with your broker to discuss how much you want to invest in your overall strategy. So what's going to happen next is you'll go into that meeting and sit with the broker, and don't get me wrong, they're going to be excited that you want to invest. but what they are going to tell you is that your strategy is too risky and that their products would suit you much better. And you know what? They're right. Their products are probably much better suited for you. But you know what their products are not? Fun. And they're also missing the point of what you're trying to do. So what's the best way to handle that situation? It's to get them to help you apply risk aversion to your portfolio. So risk aversion is essentially the concept of balancing your portfolio between stocks and bonds in an effort to produce a more secured return. Generally, stocks perform better when the economy is doing well, and bonds usually act as a safety net when times get tough, so their value tends to remain stable or even grow when stocks are losing. Now, keep in mind that's not always the case, just what's been seen over time, but it can certainly help you maintain a more balanced return no matter the market conditions. Getting back to that conversation with your broker, they would much rather sell you their company's products rather than discuss your stock portfolio. And it's not that they aren't interested, they just don't see where they fit into that picture. So when you sit down with them, understand that your goal with them is to help you with your risk-free portfolio. Your risk aversion score is going to help you understand how much risk you're willing to take on. So by determining that, it will help you understand how to break apart your investments into risky and risk-free portfolios. If you'd like to find out what your risk aversion score is, and we'd highly recommend that you do that after this lesson, there's a free one available at riskaversionquiz.com, and we'll show you more on that in a minute. And after you take the quiz, this site will provide you with your risk profile and the recommended balance for your risky and risk-free portfolios. And from there, if you're building a stock portfolio, that becomes the risky portfolio. Now, you might be thinking, I don't want to diversify, I just want to invest in stocks. And that's understandable. You want to make the most of your return, and you don't want to waste time on investments that won't get you there as fast. And while there have certainly been moments over the last few decades where stocks have performed well, we also know what the downside looks like, and you have to learn to be careful. The place where your bankers and financial planners can come into play are with some of their fixed income products. Like if they're offering you a CD or some type of fixed income annuity, you should consider that as part of your risk-free portfolio. Then when you're having that conversation with them, you can approach it as, hey, I have these stocks I'd like to invest in, and I'd like your opinion on them. But I'd also like to hear more about what types of products you can offer me that would fit into a low risk or risk-free portfolio. And if you do that, most of those folks will look at you like someone that just told them they received a large inheritance. And not because they see you as a dollar sign, but because they'll instantly know that you are someone that they can sell products to while having good discussions about the stock market. Most people get into finance because they want to trade stocks or they want to work for some big Wall Street firm and make a lot of money. Many of these folks are very committed to what they do and their products, but they aren't always able to talk about the fun things like the stock market throughout their day. They generally instead have to focus on their products. So being able to have a conversation with you about something that they enjoy, all the while you're leaving with a product from them, that provides both parties with a lot of value, and that will even, keep their supervisors happy too. And you'll find yourself in a very welcoming environment when you go to see these people, regardless of the amount of money that you're investing. Now, obviously, they'll treat you a little better if you have more, but if you don't, trust me, they'll still be excited to see you if this is how you're approaching them. Now, if you do the opposite and you go in there and you just ask them about stocks and then tell them you only want to buy stocks and don't want to buy their products, I can assure you they'll have no interest in talking with you about your portfolio. They'll probably just tell you that you're crazy or that this program is leading you down the wrong path and that you shouldn't do this. And if you're really lucky, they might even tell you that you're wasting their time. So applying risk aversion is just as much about managing relationships with financial professionals as it is about balancing your portfolio between stocks and bonds. You want them to be engaged and excited every time they see you, and if you're buying financial products from them, that's exactly the response that you'll get. Now, that said, to address any criticism, remember what you're learning here are the academic methods. What's going to work best for you in reality is what you decide, and the outcome depends on how you manage your portfolio over time. And if you have good relationships with financial professionals, you'll have more people in your corner that you can bounce ideas off of that will give you honest feedback. And part of the intention of this program is to help you understand what you need to know in order to have better conversations with them and have confidence when speaking with them about your investments. A moment ago, I talked about the risk aversion quiz that you can take in order to find out your score and portfolio balances. Just know this isn't some big test. It's only 8 questions long, and all of the answers are either sell, do nothing, or buy more. So just to show you how simple it is, here's an example of a question. It says, you recently purchased an investment that immediately lost more than 20% of its value. What would you do in this situation? Well, the risky thing to do is to buy more. The moderate thing to do is nothing. Or if you're really risk averse, you'll choose to sell and walk away. So those are the types of scenarios that are presented throughout the quiz. If you would like to know your risk aversion score, you can go to riskaversionquiz.com and take our free quiz. If you provide your email address, we'll even send you a copy of the results. Now, there's no purchase necessary, and you do not need to provide us with any information, including your email address, in order to see your results. This is just a quick example of applying risk aversion to your portfolio. So say your risk aversion score says your stock portfolio should be 52.75%. Now within that, here's the portion that you should have in each of those stocks. And then from a risk-free portfolio, this is the percentage that you should have. So looking at this, if you had a $10,000 portfolio, this is telling you to put $5,275 into stocks and $4,825 into bonds. And then out of that $5,275 for your stock portfolio, you would spend $825 on AT&T stock. Then what you can do is take the investment and divide it by the current stock price, and that will tell you how many shares to buy. So this is a method that can be applied to any size portfolio. However, we would encourage you, if you're a larger investor or you're considering investing on your own quantities that are in excess of like $100,000, ultimately when you get into some of the larger values, what you may want to do even further to hedge your risk is to divide up your investment into smaller portfolios. Say you have $1 million, well, these methods would tell you to dump, all of it into 10 stocks. For a lot of people, that might feel like a pretty volatile portfolio, and that's going to be a lot to stomach. And a lot of bankers and investors are also going to discourage you from doing that. The way you can continue to leverage these methods is to spread it out more. You might see a little bit lower return by being more diversified, but by breaking up your $1 million into 10 $100,000 portfolios, you can then apply these methods more confidently and even create different strategies for each of those portfolios. The fun part with doing something like that is you can invest, one of them in technology, you can have another one focused on energy, and then each of them serve a different purpose, and you're more connected to the companies and the results. And of course, it's always best to be diversified across a variety of sectors and industries within each portfolio. But if the portfolio optimizers say what you want to do will work well, certainly, you can give it a shot. Just pay attention to how much risk you're taking on and whether or not that return is worth it. Okay, so it's time for another question, and I hope you get this one since we just covered this. To put it simply, risk aversion means what? Is it A, dividing your portfolio between risk-free assets and risky assets? Is it B, avoiding the market by keeping your savings under your mattress? C, investing in bonds? D, investing in stocks with a beta near 1? The answer is A, dividing your portfolio between risk-free assets and risky assets. And while this concept seems simple enough, a lot of retail investors don't consider this as part of their strategy, and they should. So that's the basics. From here, we dig deeper into these concepts and cover additional information that you need to be aware of when managing your portfolio. All of these tools are designed so that you can practice these methods without taking on any risk. We understand that some of this stuff might come across as too easy, so we want to give you an opportunity to build and track these portfolios for yourself in a risk-free environment, before you invest any money of your own. And this program is up to you. We're not here to give you stock picks or help you day trade. These methods are all about how to manage your portfolio over the long term. These are not get-rich-quick schemes. Our methods will help you learn how to invest in the companies and the industries that you want while building a secure portfolio and producing returns similar to an index fund, with the ultimate goal in mind of being able to beat that index. Stocks are something that I love talking about, and I think it's something that a lot of people do as well. And whether you know a lot about it or you don't, you want to get more involved and you want to understand more about what's going on. But a lot of people just don't know where to start. And as somebody that went and got a master's degree or an MBA, where instead of a major, I did a dual concentration in finance and economics, not everybody has an opportunity to do something like that or be exposed to that information or the professors that know these things at that high of a level. But my belief, though, has always been that you shouldn't have to have that kind of degree or go to a school for that long to understand how this stuff works. And that's really the purpose of all of this, is to help you build more confidence with managing your investments without having to go through all of that. Now, this was just an introduction. We're going to get a lot deeper into all of these concepts in our next few lessons. Until next time, I'm Matt Franklin. Thank you for being here and have a great day.